Last week I talked about how in the midst of this government shutdown, we're really going to be looking at any types of information that gives us a read about the economy because we're not receiving these traditional economic data points, these releases, as various parts of the government are shut down. And so last week we saw the third quarter earnings season kick off. We heard from Jamie Dimon. He's the CEO of JP Morgan and Chase. And although the numbers were good, he did talk about how the bank actually realized a $170 million loss. And this was previously known, but he provided details around this. And it was actually tied to a failed auto lender as well as a failed used car dealer. And he talked about the fact that where you often see these cockroaches, there's generally going to be more that you don't see quite yet, but you're going to see them down the road. And so he did warn investors about this, that we are at a vulnerable point in terms of the credit backdrop here in this economy. That certainly raised some alarm among investors. We saw a little bit of a sell-off then, but we saw this continue on Thursday when we heard from a couple of regional banks, and they talked about how they were victims of fraud by two companies specifically, and they had losses and charge-offs on their balance sheet in the tens of millions. And so now we are seeing there is more and more talk about a potential credit event, and are there more cockroaches here that we don't see yet that are going to make their presence known here in the days and weeks to come. And so not surprisingly, I did hear from one advisor here over the last couple of days. They actually passed along an email from a client of theirs and said, hey, I remember this is how the credit crisis back in 08 started. I remember hearing about similar things. This sounds awfully familiar and seems similar to what we saw a couple years ago when we saw some trouble among the regional banks. And so they said, is this another one of those episodes? Do I need to worry? And so I'll tell you what I told them. So far, we do believe that these are more isolated events. We certainly are on the lookout, as I think other investors are as well. But we're looking at a couple of things here in the economy. First, I would just highlight the fact that default rates in high yield loans remain extremely low. They are actually below 5% in the junk bond market, and these actually hit double digits during the financial crisis, and again a few years ago during COVID. We saw these jump again. And so we are not seeing this just yet. We are actually seeing that on the whole, the other banks that did report last week, they did actually say that they're seeing delinquencies fall, and they're actually reporting lower charge-offs. And net charge-offs simply meaning that they announce these net charge-offs when they don't expect to collect on any of this debt that they've or loans that they've provided. So the fact that these are declining is a good thing. And so I will just highlight that this week we are scheduled to hear from a couple more regional banks. And so it'll be interesting to see if any of these other cockroaches do appear. We'll look to hear a little bit more information on these two companies that are accused of fraud and led to these losses at the two regional banks that I mentioned. And by name, those are Zions and Western Alliance. And so I think that we are in this vulnerable period, but for now, we do believe that the broader credit backdrop is still okay. Now, for those who are concerned, I will just highlight the fact that within our portfolios, we've had a bias towards quality. And there's a few ways that you can express that. In the equity side, we have a bias or a preference for larger companies. And in our individual stock portfolios, we don't have too much bank exposure, but the exposure that we do have is on the mega cap banks, those large money banks. We do not have any regional bank exposure. And I would just highlight that during last week's events, it is those regional banks that actually saw the biggest hit. So we don't have any of that exposure directly. In terms of our fixed income allocations, again, we have a bias towards quality. We do not have any dedicated exposure to high yield or junk bonds. And so if this does turn into something more systemic, more sinister, we are positioned appropriately within our portfolios. One thing that we are watching is there's actually a visual here, and it shows the option adjusted spread or the spread levels of the high yield bond index versus a treasury. And so really what this is looking at is how much additional premium in terms of yield are investors demanding for buying lower quality bonds over treasuries. And so this is about 3% or 300 basis points. We saw it jump last week in response to the events. It is still well below what investors were demanding following the Liberation Day in early April. And so fears have not hit that level yet in the credit market. It is certainly well below what we saw when Silicon Valley Bank failed a couple years ago. And we really saw a lot of people talking about a potential systemic threat to these major banks and lending institutions. So we are not quite there yet, although the reason everyone is hypersensitive right now is because we know if stocks are at all-time highs, then, and some might argue we're priced for perfection, it just means that we are vulnerable to downside surprises. And these are the things that we're on the lookout for. Well, I'll leave it there for now. As always, don't hesitate to reach out to your advisor if you have any questions, and I'll catch you next time.